This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. In case you're new, on the weekend I like to come back and check in on the base case hypothesis for the channel. Largely speaking, to check for invalidations. If invalidations are going to occur, then I want to know in the first instance so that I can adapt and figure out exactly what I got wrong. And if no invalidations have occurred, everything is going according to plan, then I can have a lot more confidence in my posturing and positioning for all of my trades. So far, this base case continues to play out according to my expectations. So if you're new and you're interested in following along, be sure to hit that subscribe button and let's get into this. The primary hypothesis for the stock market was that at the lows we were too bearish and we were going to have this big push to all-time highs. We would see rate cuts come in somewhere around the top and then we would enter a recession and a bear market. And since we were at the end of these multi-decade cycles for the stock market, wherever this high ends up forming could potentially remain the high for up to around a decade. We have seen multiple examples of this before, where we kind of had this lost decade whilst the oscillator resets down the bottom. And so far, it is showing the familiar symptoms of seeing such a reset. When we hop in and take a look at the stock market, it appears to be entering its final near vertical blow off top angle. And of course, this did coincide with seeing the onset of a Fed cutting cycle. So far, so good for the stock market. The plan, as ever, remains to see if we can get a nice big push up on this third angle and then look to exit the market and flip short on a third angle violation. Bitcoin remains the one component that didn't quite play ball as expected. We were proposing a left translated cycle, meaning a top before November of this year, and thus implying that we would have to spend about 2 years in a bear market before we could find that next 4-year cycle low. This theory managed to successfully predict an all-time high pre-halving. However, we did spend far longer than I anticipated in here, and so again I say this remains the only component that hasn't quite gone according to plan. There is still time, however, to see one final push to the upside, and if we do get an earlier than expected top, whether that is left translated, meaning before November, or slightly right translated, perhaps as late as Q1 of next year, overall it won't be too far from expectations, and more importantly, it will imply that there is a significant bear market ahead in terms of time, meaning we will likely undergo a bear market for more than the 12 months that Bitcoin is used to seeing. Today, Bitcoin is still holding this parabolic curve. This may have taken longer than I anticipated, but I do still think there is scope to see a push to new highs in the not too distant future, followed by that larger time correction that I was speaking to earlier. And thus I still make the case that both a left translated cycle and this fifth wave in the Elliott system is still very much on the table. You can see this schematic down the bottom. We went 1 into 2, 3 into 4 with a throw under, and then we look for a throw over of the channel. If we were to do the same thing, 1 into 2, 3 into 4 with a throw under, and then blast off from here in a near vertical fashion, we might even see a throw over to the upside, and that would put us somewhere around 150k by the end of the year. Seems absolutely crazy, but so did an all-time high before the halving, so as of yet, I am not quite ready to discount this. However, like I said earlier, objectively speaking, we did spend longer in this neighbourhood than I was anticipating. This still remains the one component that hasn't quite played ball as per my expectations. If indeed this thing is going to continue to be correct, and if indeed we are going to see a recession, a bear market, and major tops come in for risk assets within the next few months, a key component of this hypothesis was that this crash would have a deflationary component to it. I have long been making the case that anything you do to the M2 rate of change shows up in the inflation or the CPI print, albeit with about an 18-month lag. This one metric has enabled me to successfully call inflation for this entire cycle, and that is because I've been making the argument that this snapback, sideways wobble, and final leg to the downside corresponded with this snapback, sideways wobble, and that we would continue to the downside in inflation. The key part in here was that the majority of the market perceived this as sticky inflation and was using that 1970s overlay to suggest that what comes next was another round of inflation. For a few months in this neighborhood, I kept saying, no, this portion of the M2 rate of change is yet to show up, and thus the real risk here is continuation of disinflation before ultimately a short period of asset price deflation. And this was particularly true because the Fed has been late to cut. And so, of course, if this is true, we should continue to see CPI come off. At the last CPI print that we saw, we got down to 2.5, which means this is well on its way now to seeing this portion of the curve manifest. And this week we saw additional data in the form of US PCE price index, which came in at 2.2% year over year, below the forecast of 2.3% and significantly below the 2.5% that we saw for the prior month's readout. Remember, PCE is significantly less susceptible to the volatility that we see in the CPI basket. So inflation is now continuing to drop right before our eyes, right in the expected timing window. And again, this speaks to the Fed being very, very late to cut. And it's going to be one of the components that forces the Fed to continue to cut more and more aggressively as it slowly but surely realizes it is indeed significantly behind the curve. To further visualize this PCE data, this is the lowest print that we have seen since April 2021. And again, I am here to suggest that this is not going to slow down anytime soon because the Fed is so late to cut. We've got further evidence of this here because as the Fed is already starting to cut rates, the 2-year yield continues to plummet, pricing in those additional and aggressive cuts that are coming in the future. All of this is occurring against a backdrop of unemployment, which was another core component of this hypothesis that unemployment would continue to spike. Whilst the Fed currently has projections that look something akin to this, I have been making the case that unemployment is going to continue to spike. We have already done the gradually portion and we are now getting ready to see that suddenly portion come in. Major invalidation for this would be if the unemployment does not continue to spike. If we start to trade sideways or roll over, then we can say, yep, that's invalidated. If inflation starts to stick instead of fall rapidly like I expected to, that will also be an invalidation. But so far, because this labour market deterioration and the inflation coming down so fast is occurring against a backdrop of not only a cutting cycle, but a yield curve inversion that has now reverted back above the zero line, I continue to make the case that we are getting ever closer to that bear market and that global recession, all against a backdrop of a consensus in the market that the US is heading for a soft landing. Objectively speaking, so far we have indeed got a soft landing. We have had inflation return towards that normalization target, and we have so far avoided a recession. But remember, this is always what the consensus is right before major recessions occur. And we saw this exact same type of headline proliferate right before the top came in 2007. Many investors are also making an argument at the moment that everyone is calling for a recession. But the reality is the people that matter, the institutional analysts, the analysts on Wall Street, are still postured 89% in favor of no landing or a soft landing, with only 11% of analysts on the street calling for a hard landing or a recession. So calling for a recession here, despite all the doomsaying and fear-mongering that you may see on Twitter, is actually a highly contrarian trade. It's not just the US that is seeing labour market deterioration. We are seeing this in many other places around the world as well. Germany, as an example, has employment shrinking at the fastest pace since the C19 era, again, starting to have more and more recessionary looks. We're also seeing things like manufacturing PMI start to continue to cool off. Remember, a reading below 50 is indicative of a slowing economy versus a reading above 50, which is indicative of economic expansion. Services continues to buoy this ship, but continues to slowly but surely wane. It won't take much longer, in my humble opinion, before these numbers start to turn down below 50 as well. And then I think we really are going to see a world of pain. Every weekend when I do one of these deep dives, I manage to find more and more anecdotal recession indicators. Here's another one, okay? USA consumer confidence, present situation. This is from all the way back to the 1970s. And note how the pink vertical bars denote the NBER recessions. This is already flashing a recessionary indicator, just like many, many other recessionary indicators that are already flashing. And remember, the National Bureau of Economic Research, who is in charge of officially declaring recessions, is typically around 12 months late to declare them. For example, during the GFC, they came out in December of 2008 and declared that they had been in a recession since December of 2007, a full year after the recession and the bear market had actually started to play out. We are also seeing the consumer continue to get decimated as consumer auto loan delinquencies continue to skyrocket. The level of 60-day loan delinquency rates for prime auto loans jumped to the highest in over 14 years. And at the same time, subprime delinquencies are near the highest in at least 18 years, above the GFC levels. Once again, starting to have all the familiar symptoms of recessionary tendencies. And with the Fed starting to cut by 50 basis points, another 50 basis point cut is expected at the next meeting, and we continue to see all kinds of central banks around the world also following on this path. So once again, I am here to make the case that there might not be a great deal of upside left in the risk assets. Yes, I am currently long and strong. I'll show you the positions in a moment. Yes, I think there is more upside ahead of us, but I do think our days are slowly but surely becoming numbered here. I think there is less and less time that it will be reasonable to remain long. And I think when this is all said and done, if we were to look back at these days, at these moments, at all of these recessionary indicators, at the labour market deterioration, at the fact the Fed is late to cut, at the fact the inflation is going to continue to plummet, I think all of this in hindsight is going to prove very obvious to a lot of people. Unfortunately, I just think that's going to be far, far, far too late for most. As the bond market continues to price yields to the downside, forcing the Fed to continue to cut more and more aggressively, as the Fed slowly but surely starts to work out that it is indeed late because of the inflation, because of the labour market deterioration, the stock market market is most probably going to do what it tends to do in most of these other cases where we have a backdrop of an inverted yield curve and cuts into a slowdown rather than normalization. I do believe this stock market is getting close to seeing a major top. Whether you are a macro guy, whether you care about the macro data or not, when we zoom out and look at this is indeed the third and final angle in what is a typical parabolic blow-off top structure. When these things do break down to the downside, particularly if we see a further squeeze like I am expecting, they tend to violate spectacularly to the downside. The first angle becomes the minimum target, and I think if we have the kind of deflationary shock that I'm expecting to see, we are likely going to lose that first angle and end up targeting below these lows. So overall, based on everything I presented today, I continue to stand with my posture. I continue to believe that my assessment is correct. I don't see any invalidations occur, and thus I'm more than happy to sit here and be confident in my assessment, in my posturing, and in the trades that I currently have open. If you're interested in following along with my live trades, if you're interested in seeing my trade setups called out ahead of time with public stop loss levels, make sure you hit that subscribe button and turn the notifications on so you don't miss any of those updates. Starting off with the dollar, okay? The dollar looks like it is getting ready to me to break down of this key 100 level. I have been making the case that when we get that, we are going to get a violent snap to the downside into the mid-90s, and then we are going to be forcing a 3-year cycle low and looking for that deflationary recession to come in. The key components to this are, one, that initial breakdown should be like throwing kerosene onto a fire and should ignite those third and final angles in the stock market. It should ignite Bitcoin to make that fifth wave to the upside above 100K. And then as those third angles break down, as we start to see something like this occur, as we start to see this parabolic advance broken down for Bitcoin, I would expect to see investors like myself flee the risk assets, the stock market and Bitcoin, and hide in the short-term safety of the dollar. This will put a massive bid under the dollar, will allow the dollar to find its 3-year cycle low and break out, and that's when I think we get the deflationary component. We've been trading in and out of gold this entire time, and so far we're long and strong. I have indeed choked the stop up below the body of this candle from the 24th of September. So if this thing will continue to push higher, I will continue to trail my stop up until I'm taken out. And if that was the swing high before this daily cycle low, like I suspect it might be, then I'm about to be taken out of this trade and getting ready to reallocate at that daily cycle low to play a short-term bounce before ultimately a weekly cycle low comes into focus. The stock market is also getting quite stretched in its daily cycle. As of Friday's close, we closed day 38. We should be looking for a sharp and sudden decline into a daily cycle low over the next few sessions, and then that becomes for me the final time to add exposure, to move stops up, and then the focus for me will be on selling a third and final angle breakdown where I'll be looking to officially declare tops and flip to being net short in the stock market. For the Dow Jones long that we've got open, we continue to expect essentially the exact same thing, a decline into a daily cycle low, one final addition of longs, and then we'll be looking to dump the whole lot again. Same deal for the Nasdaq, some kind of pullback, and then a cycle low and go would make the most sense to me. And of course, the Russell 2K, I'm expecting roughly the same thing to occur. Now, what's really interesting about this is the VIX finally got its little pop-up here. I was talking about, since the stock market is due for that cycle low, we should be expecting to see a pop-up from the VIX before one final rollover after those cycle lows are found. And through this week, I've been talking about how that component was missing. However, on Friday, we did indeed get the start of that pop-up for the VIX. So I like what I'm seeing here. A few candles up like this whilst we find those cycle lows, and then you would expect this thing to make one new set of lows whilst the stock market has its final push to the upside, and that's where for me I'll be looking to get some longs on for the VIX. So happy days there. And last but not least, the long from the cycle low for Bitcoin starting to look a great deal better. More importantly, we have now had a higher low and a higher high for Bitcoin, and the longer we spend above that high, the more significant it becomes. Something to keep an eye out here is we are expecting some kind of half cycle low shakeout around day 30, which is about the 6th of October. So it makes me wonder if we'll get something like this. Quick, sharp shakeout into a half cycle low, and then we can talk about breakout, retest into the cycle low, and resumption up to that new all-time high, in line with seeing Bitcoin complete this fifth wave to a left-translated cycle top. So a wild time to be alive. As ever, we'll continue to take this thing one day at a time. I'll continue to call out the trades ahead of time and let you know when I'm going to take some new positions. If you're a level 3 member, look out for the members-only video I'm going to put out for you guys in a moment. For everyone else, be wary that we may well see some shakeouts into cycle lows as of Monday and Tuesday's session. And other than that, I hope you're doing well in life. Have a fantastic weekend. Until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel Finance got the markets key, taking us normies on a bump.